And in a recent development, the Reserve Bank of India's Monetary Policy Committee opted to maintain the policy repo rate at 6.5%. And after 6 consecutive hikes, the RBI has kept rates on hold since February. But let's delve beyond the numbers and decipher the implications for India's consumption-driven economy. Take a look at this next report for more.
COVID, the Russia-Ukraine war, and a spike in commodity prices affected inflation in all major economies around the world, including India. In response, the Reserve Bank of India hiked rates by a cumulative 2.5% from April 2022 to February 2023. This led to higher borrowing costs for Indian consumers, particularly impacting home loan borrowers, who saw their repayment terms extended by almost 5 years. Now, borrowers might find some relief as interest rates appear to have reached a peak. However, RBI Governor Shaktikanta Das said inflation remains sticky, primarily driven by a surge in food prices.
The moderation was observed in all components of CPI, namely food, fuel and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December.
With a vigilant focus on bringing inflation closer to 4%, experts suggest a rate cut cycle may be delayed compared to earlier expectations. This implies that borrowers will have to contend with higher debt repayment for longer. Despite high interest rates dampening borrowing appeal and reducing demand for goods and services, India's consumption continues to demonstrate strength, propelling it as the fastest growing major economy globally. Nevertheless, the RBI faces a delicate balancing act as it navigates in interest rates, economic growth, and inflation. Bureau Report, WION World is One.